Welcome to Yahoo Finance Live. I'm Josh Lipton. That's Akiko Fujita. Let's get you caught up on everything you need to know. We're going to start here with stocks, which are searching for direction right now in today's trade. Markets edge higher from the best weekly performance this year. Investors will be keeping a close eye, we know, on a lot of Fed speak this week, that including from Fed Chair Jerome Powell. We get you prepped to make smart investing decisions.
Plus, Disney finally filling the role of chief financial officer, hiring away PepsiCo's CFO. We're going to look at that move, plus other C-suite shakeups. That's straight ahead.
And Disney earnings are one of the key reports to watch this week. Citi media and entertainment analyst Jason Bazinet joins us with what you need to know ahead of those results.
Let's get you up to speed on the market action, though. Just 30 minutes left to go in the trading day right now. A bit of a flat day on Wall Street when you look across all three major indices. All in the green, the Dow pretty flat, as is the S&P 500. The Nasdaq up about 20 points. In terms of sectors we are watching today, energy as well as real estate among the biggest decliners on the day. We are seeing some upside here in terms of health as well as technology stocks. But Josh, a busy day when we're talking about what's been playing out in the corporate world.
That's right. Busy day in the C-suite, specifically shakeups announced at several big names. Disney naming PepsiCo's Hugh Johnston as its next chief financial officer. Then there's Whitney Wolfe Herd stepping down as CEO of Bumble, the dating app she founded. And Overstock CEO Jonathan Johnson was ousted after an activist called for him to step down last week. So let's start there with Disney, Akiko, because that is a big move. We have hiring Hugh Johnston, new CFO. He comes over from Pepsi, starts on December 4th. Of course, a tested, experienced executive, brings a lot of years to the table and has his work come out for him, right? I mean, the stock right now, we're actually down about 3% year to date. So how can he help get investors excited about owning this company when you have these challenges facing traditional TV as well as these losses in the streaming business?
Yeah, he's a name that Wall Street is very familiar with. We should point out, by the way, at least according to what's been reported out, he is one of the first outsiders to be tapped as a key executive in the company in decades. So, what does that tell you about where Disney is? It's exactly what you pointed out. There is a lot of pressure for Bob Iger to really rein in some of the costs. There's a number of key decisions they have to make. What's going to happen with ABC? Is there a potential sale there? Are there going to be partnerships for ESPN? All of this is what Hugh Johnston walks into. And of course, he has been at the helm, at least as the CFO of PepsiCo, for more than 30 years. So a very trusted name on Wall Street. And that does speak to sort of the cost discipline that Disney's going to have to really.
Yeah, and another question for Bob Iger. Who comes after Bob Iger, right? He's doing his second tour right now. You do wonder, like, Hugh Johnston is that, and he's 62 years old. Is he beginning? Maybe he gets prepped for the big chair at some point. Per Bloomberg, in terms of what Ms. Johnson would be paid here, he's going to be paid a base salary of $2 million and a bonus, also a one-time signing bonus of $3 million and a stock award of $14 million.
Yeah,
so good work if you can get it.
Yeah. Why can't we get that? This is a conversation we have a lot, by the way. Let's talk about the other stock that we were mentioning here. Whitney Wolfe Herd stepping down. She is the founder of Bumble, we should point out. This company she started when she was 24, now 34. The stock, though, down about 38% year to date here. It's interesting to me, not necessarily her stepping down so much as who's taking over, because we're talking about a name that we heard just earlier this year taking over as Slack CEO, now sliding over to Bumble to take over some of the challenges there. That's been happening not just with Bumble, but in the overall online dating space.
Yeah, and there are analysts who express some concern about the news and leadership changes, because they note that this is the second leadership change in the past 6 months for Bumble. It follows the announced departure of the president back in May. So the team at Jefferies, Akiko, for example, they told their clients, we worry that the lack of consistent leadership in the C-suite will make it difficult for the company to establish a consistent strategy. We believe Bumble, they says, has failed to execute on its vision of becoming a broader women's platform for beyond dating use cases like friendship and professional networking.
Well, and you also have to wonder what this means for Slack, right? Lady and Jones moving over. She was just tapped to be the CEO of Slack in January of this year. She's now moving over into the role of CEO at Bumble. That leaves a big hole for Slack as well. Still trying to sort of get its footing since Stuart Butterfield left.
And I'll mention this to Jefferies. I thought this was an interesting point, too. They know Jones was appointed as the CEO of Slack to tighten the M&A integration with Salesforce, and that leaves them wondering, they said, whether Bumble would consider a potential sale. So one to watch.
Okay, something to be keeping a close watch on. But Wall Street looking to maintain its momentum after stocks locked in their best week of this year. This comes amid hopes that the Fed is ready to call an end to tightening. However, Barclays saying it out expects the central bank to deliver a rate hike in January instead of December. Here to discuss this and more is UBS Wealth Management Managing Director Brad Bernstein. So, Brad, I've got to put you on the spot here. Do you expect a hike come January?
No, we don't see that. Our base case is the Fed has finished in this cycle. And the markets, if you're looking out at the futures contracts today, they're already predicting a pretty high probability of cuts by April and May of next year.
And where, Brad, do you think yields head from here? Or do you think the 10-year, has it already peaked here?
We do. We see the 10-year by next summer potentially down 100 basis points from here. We're recommending right now for our clients to be adding to balanced portfolios because we love the fixed income market and we like the stock market at these levels.
So when you talk about having a more balanced portfolio, what does that entail? I mean, how are you trying to shake up that portfolio right now with the anticipation that those yields will fall?
Sure. So, that's dependent upon each individual client, whether it's the traditional 60-40, 80-20, it's dependent upon that client's goals and objectives. But we're looking at 9% potential earnings growth next year on the S&P. We're seeing, a real great opportunity in the fixed income market with dropping yields. And we think there's potentially 8 to 10% in the stock market over the next year. So we really like fixed income here and we like stocks. So we, as I said, are recommending to clients to just layer in to their diversified portfolios at these levels.
And in terms of stocks, Brad, are there certain sectors that you think are more attractive right here at these levels?
So we do think value right now looks more attractive based on valuation than growth. However, that being said, within technology, we're very bullish on the areas within tech that are beneficiaries of AI, specifically semis and software. So, when you look at earnings right now, in technology, it certainly looks like they've troughed, and the first time in a while, earnings look really on store for a great year next year of growth.
I mean, is that because you expect the revenue to start sort of showing, for lack of a better word, for some of these companies? I mean, we've been talking about the cycle that we've seen this year, sort of the hype at the beginning of the year, the show me investors sort of being a little more discriminatory on these AI stocks. Where we are today, if you're expecting a 16% upside next year, what's going to be the lever?
AI. So we really think AI is going to drive tech growth next year. And when we look at valuations in tech, they look very appealing right now. So we're actually thinking 16 to 24% next year in earnings growth in technology. And it'll be one of the fastest growing segments within global equities.
And when you say AI, Brad, are you expecting next year, you think that AI for a lot of these tech companies, by next year is going to starting to generate fresh revenue and profits?
Yeah, and I don't think I'm alone in saying that. I think there's a lot of consensus right now out there that AI is what's one of the most amazing things about AI is how fast it's coming onto market. Whether you're looking at news stories this week about PC demand going to take off next year because of AI. So it's amazing how fast this new future technology is impacting results that we're going to see next year.
Brad, what about opportunities outside of the U.S.? Are you mainly just overweight U.S. equities, or do you see some opportunity potentially outside of the U.S.?
Sure. So we do overweight U.S. equities to international, but we do think global equities look extremely attractive. When you look around the world, there's a lot of areas outside the United States that look attractive. And even in the United States, there's areas such as small caps that are trading at generational discounts to large cap. So there's a lot of areas within the markets that look very appealing to us right now, other than just tech.
And Brad, I want to get you out of here on this. I know you also think fixed income looks attractive here. Where in fixed income, Brad? Is it treasuries, corporates, munis?
Sure. Well, if the 10-year does drop 100 basis points over the next 8 months, as we believe, you're going to do very well owning high quality treasuries, corporates. Should bode very well. We think municipal bonds also look incredibly attractive. The highest yields I've seen in my career, since 06, 07. And they're not going to last. So we're pounding the table right now on fixed income with our clients. The cash, which has been king for a lot of the last year, will not be king over the next year, as there is risk that yields will fall over the next year in the bond market. So you want to lock in duration.
Brad Bernstein, thanks so much for joining us today, Brad. Appreciate it.
Thank you so much for having me.
Paramount stock fallen today. That's after getting hit with a downgrade from Bank of America. Analyst Jessica Reif Ehrlich slashing her rating to underperform from buy and cut her price target to $9 a share from $32. So this one, Paramount here, this is the rare double downgrade, Akiki. This is a steep cut. You don't see that very often. I like it when they come out, they take big swings. So the analyst goes from buy to underperform, so the equivalent of a sell, slashes the target to $9. It sounds like what she was counting on was asset sales here, right? And that just isn't happening. She says there have been credible bids for certain assets like BET, like Showtime, but it doesn't look like any significant asset sales are on the horizon. And here I think is her money quote to her clients. She says, our concern is the longer it takes to execute potential asset sales, the less value they can ultimately garner. So she is off. Sell.
Essentially saying there's no real upside to shares if you don't sell and you're hanging on to it. I mean, that kind of what it comes down to. I think you're right on that key quote there, saying that there are opportunities here. There have been some rumors about those swooping in to buy a Showtime or a BT, but Paramount hasn't necessarily gone after that. So her concern is the longer you wait, the value comes down as well, which is why we've seen a decline in Paramount shares today on the back of this double downgrade. Well, Dish shares plummeting today after the company reported third quarter results. Revenue and wireless customer numbers were both much lower than expected, causing the stock to have its worst day in 23 years. The backdrop, of course, against this, all of this, Josh, is that Dish is a company that is really in transition. Not unlike some of its competitors, they've lost subscribers to viewers who have moved over to streaming. They have doubled down on the wireless side of things, right? Aggressively buying up spectrum, betting on 5G. That very one that they bet on did not come through, at least in the quarter. Dish lost nearly 5 times as many mobile customers. We're talking about a decline of 225,000 when the street was expecting 46,000.
Yeah, I'm looking through. I'm trying to find anything positive on the street. There really isn't much. In terms of the financial analysts who cover this name, Moffett-Nathanson calls the report astonishingly bad, in their words. They say likely Dish enters bankruptcy sometime in the next few years. And this report confirms they see that projection. They're neutral with a target of $5. Citi's also neutral, saying the results are underwhelming. Their target is $6. The majority of analysts covering the company now, it looks like about 61% here, have a hold on the name at this point.
And underlying all of this is their debt, right?
Yep.
$20 billion is what we're talking about right now. And as we've said over and over on the show, it's not just about $20 billion. Remember, when you think about where rates are right now, those borrowing costs are going up even further. They don't have that additional revenue driver that they thought they would have. Also points to the challenges of really trying to pivot to wireless.
Yeah, not easy, and they're getting hammered today on it. Finally, here, let's check out shares of WeWork. They have been halted most of the day now as Wall Street prepares for a bankruptcy filing. So we're still waiting for the news here, Kiko. It's been halted for a while now. Listen, the company, we saw the reports and the headlines, we're expected to file for bankruptcy. It is a remarkable story. I mean, it is a former darling of Silicon Valley, venture investors of Wall Street. It was once valued, Kiko, at nearly $50 billion at one point. Office space from London to Manhattan. I mean, millions of square feet, but now going bust, it looks like.
Yeah, the thing that I keep repeating is, as is this expectation of WeWork filing for Chapter 11, for all the talk about the challenges, the hype that was brought up through Adam Newman, it really was the real estate market that kind of did the company in, right? When you think about WeWork at its peak, there were still warnings out there, even as VCs were throwing money into it saying, this is really a real estate company, and when that market turns,
right,
the company is going to face its struggles. And here we are talking about the very issue. The company announced plans to renegotiate all of their leases back in September. At the time, they said their lease liabilities accounted for more than 2/3 of its operating expenses. They've already missed an interest payment that was key there. That sort of gets the clock ticking for a potential default 30 days from now.
Yeah, COVID-19, remote work, higher rates, it was just too much of a challenge for the company with this shared office space, right? So, I mean, if we see the filing, the bankruptcy, I think shareholders likely get wiped out. Creditors hope to recover something, right?
Yeah. Adam Newman also weighing in, right?
Yep.
So kind of mentioning, although he's not necessarily involved with the company anymore. So we're going to continue to watch that. But we're just getting started here on Yahoo Finance Live. Coming up on the other side, a fresh warning on the EV industry. A key lithium producer hit with a downgrade at UBS today. The stock recently hitting a 52-week low. And earnings ahead. We're going to preview Disney's fourth quarter results out on Wednesday. And it's a big week for Yahoo Finance with our Invest conference taking place all day tomorrow. We've got some huge names ready to discuss the most pressing issues in the investment landscape today. You certainly don't want to miss it. Much more on Yahoo Finance after the break.
It's time now for this week's Options Pit, sponsored by Tasty Trade. We're looking at what you should consider after the S&P 500 had its best week of the year last week. Jared Blickery is here with Chris Brecher, Simpler Trading Senior Managing Director of Stocks. Jared.
Chris, thank you for being here. Let's go to the Wi-Fi Interactive where I have one of the charts that you've given to us. This is the S&P 500 going back to March of this year. We also have the 200-day moving average, which the market is now just above. We've also had this huge run-up, and we're seeing the MACD into extended territory to the upside. What are you seeing in the market right now, and how would you express your views through the options market?
Well, the first thing, if it wasn't holiday time, I'd be all over shorting the market, or at least looking for an hourly reversal to just buy puts. But because of this time of year, when you're overbought at the 200, I'm going to look a lot more at like an SPX butterfly under the market. So I'm looking at, and the reason I'm doing that instead of buying premium is it drives me nuts buying premium, and if you're right, but it goes down slowly, especially at this time of year. So I would rather do something like the 4,400, 4,200, 4,000 put fly for like March. So that way, if the market just sits here, because on the one side you have the bonds going down, which is bad for the markets in the long run. You have the overbought, which is bad for the markets just short term, but you have holiday that might keep it elevated. So I think that's a cool way to play a downside or a drift.
I hear you about the options market, especially buying premium. Let me move on to another market here. This is biotech, and here we have the S&P Biotech ETF XBI. I believe this moving average is a 50, so it's up against that. But we're actually 60% off of the highs that were created in 2021. So a little bit more of a depressed market, but again in the MACD, we're seeing this pretty rapid rise recently. So what are your views on biotech here, and how would you play that?
Well, we were looking at different scanners and looking for indexes that have been down the most this year, going on, trying to take advantage of the easing of tax loss selling. And our favorite was really XBI in the theory that no matter what the markets do, it could bounce anyway because it's so underperformed. The key for me is the overbought condition, how it's worked off. So when it works it off, is it going to have a massive reversal, or is it going to work it off by retaining some kind of bullish structure? But right now, I'm looking to do spreads in there at or above the markets. So definitely that's a sector I'd like to buy dips, no doubt about it. In fact, I bought some just now, but not a lot, because I'm still waiting for that overbought to be worked off.
All right, duly noted. And want to move on here to Disney. We're expecting the earnings in a couple days after the close on Wednesday. This is another stock, coincidentally, happens to be 60% off of its highs, peaked in 2021. What are you seeing in Disney right now?
Well, it's sort of neat. I sent a chart earlier saying that I'd be interested in doing a spread. I sent a chart to Yahoo about I'd be interested in doing a upside spread if Disney could fill the gap from Friday, and it's almost filled the gap. So the way I'm looking at playing it is a lot of these earnings trades. If something is rallied into earnings, then there's a high bar into earnings, and no matter how good the earnings are, it sells off usually. So that's why if Disney was up near the highs, I'd be like, I'm not going to play it on the upside. I would like to see it under 83 and then play something like an 84, 88, 92 for this week. So that's a real bullish idea, but it's all of 78 cents. So it's a 4-point wide, risking 78 cents. But I'd much rather see the stock down another 90 cents and shift it to an 87, 91, 95. So I'd rather do it 1 point lower, but I want to see if it fills that gap.
All right, real quick, we got under a minute. Would like to get your views on the Dow Jones transports. In terms of Dow theory, that's one aspect, but just how are you seeing the transports right now? This is a year to date, and here's a 2-year view.
Same thing with it overbought, but it's so far under its daily 50 moving average that while the NDX is above it, so I want to buy dips in the transports. I know it's looked awful, but I definitely want to buy dips in the transports. Right now, I do it with IYT, not with the Federal Expresses of the world. Just that's the ETF that includes all the Dow Jones transport stocks.
Okay, Jared Blickery, thanks so much for that, along with Chris Fletcher. Appreciate the time. Well, after recently hitting a 52-week low, lithium producer Albemarle faces a downgrade by UBS. The moves come as stalling EV demand is impacting the price of lithium. Let's bring in Yahoo Finance's Inez Ferre with the breakdown there. Inez.
Yeah, Kiko, and Albemarle and other producers of lithium getting hit recently. And this has to do with two things that are happening at once. One is the falling price of lithium. The other one is concerns about the electric vehicle market and demand going forward there, demand slowing. So let's start out with lithium. Lithium is the component that is critical for electric vehicle batteries. And lithium prices have been falling from their peak last year. In 2022, you saw lithium prices north of $70,000 per ton. Right now, they are down below $20,000 per ton. That's the spot price coming out of China, because remember that lithium doesn't trade on international exchanges like oil or like gold, but there is a spot price that comes out of China. Companies have contracts with manufacturers, battery manufacturers, for example, and those contracts are private. But nonetheless, there is also that concern about what's happening with demand in the electric vehicle space. And you've had Ford, GM scaling back their EV initiatives. You've had Elon Musk of Tesla talking about demand and also this high interest rate environment. He's worried about that, saying that they have to find a way to bring down the price of vehicles so that people can buy them. So now you've had analysts that have downgraded Albemarle to neutral, talking about that EV growth forecast, that it's being lowered, also seeing an oversupply of lithium and cutting the price target on the stock to 143. Now, Albemarle has price floors on its contracts, on 80% of its contracts. That's to protect its operations and to protect it from falling prices. Not everybody is that bearish. You do have Morningstar analysts that are saying that there is just too much concern in the market about oversupply of lithium. They see that the market will rebalance in the next couple of months and that lithium prices will go back up in 2024.
Okay, we'll be watching that one closely. Ines Frey, as always, thanks so much for that. Well, coming up on the other side, we've got the closing bell on Wall Street. We're going to check in on the latest market moves and the top trending tickers. Stay tuned. Much more to come here on Yahoo Finance.
Closing bell on Wall Street. Let's do a quick check of the markets here. Stocks try to gain some traction today. Ultimately, it looks like we're going to finish here. Little change. The S&P 500 up about 0.2%. Tech-heavy Nasdaq about 0.3%. See the Dow there tacking on about 35 points. Of course, that was after the S&P 500 notched its best week of 2023, so perhaps a bit of a breather here. Meanwhile, let's take a look at Treasuries as well. The yield on the 10-year rising in today's trade. It looks like we're going to finish here, just checking, at about 4.651 today. Remember, it hit 5.02% on October 23rd. Was that the peak? That is one big issue, of course. A lot of investors and strategists are now debating and discussing. As for the Fed's next move, remember, we're going to hear from a number of Fed officials, including Chairman Jerome Powell, over the next few days. Kiko.
Let's talk about some of the big movers of the day. Citigroup reportedly considering job cuts of at least 10% in several major businesses. CEO Jane Fraser has been working to cut costs and previously said in September that layoffs would be coming. We saw shares there down just slightly, about 0.5%. Josh, this is based off of reporting from the CNBC. They put that 10% number out there. That's new. We know that Jane Fraser, since she took over in 2021, has really been assessing the landscape here for what is the third largest bank. It is all about returns for investors. They haven't gotten that. And when you consider the current landscape, at least the thinking reported by CNBC is that you've got to go with the cost cutting because there are not a lot of levers they can pull if they're talking about 11 to 12% return, which is what Jane Fraser has announced in terms of the goal or target.
Yeah, so CNBC is saying, listen, it could be at least 10%. And Citi has about 240,000 employees, so that would be obviously a pretty deep cut. It sounds like we probably won't know for sure, Kiko, until about Fraser's plan here until the bank announces Q4 earnings in January. But remember, Fraser vowed to boost Citigroup's returns to at least 11% in the next few years. Mike May at Wells Fargo, we know Mike very well. He was telling CNBC on this report, not one investor I've spoken to thinks they'll get to that return target in 25 or 26, he says. And if they can't generate returns above their cost of capital, which is typically around 10%, they have no right to stay in business. So Mike, talking tough. That's why we like Mike.
Tough words.
Yeah, tough words. All right, moving on. Let's switch gears here. EV giant Tesla reveals Giga Berlin may build its long-awaited cheap electric vehicle. This comes as Tesla workers in Germany may be getting a raise as union pressures rise. Shares here in today's trade were down about 0.3%. Meanwhile, EV maker Lucid may be forced to slow production as losses mount. That's according to Bloomberg Intelligence. So a couple of different EV stories today. The Tesla one was interesting. He goes, this is basically a more affordable Tesla could be on the way. Reuters saying Tesla will produce a new model. It's going to cost about $27,000. We didn't actually get any kind of timeline here of when production would actually start. But I guess you could argue, you could see the strategy of it. You could bring out, like in Germany, where the economy is sort of just kind of limping along there. If you had a more affordable car, in theory at least, maybe that finds demand.
I mean, there is a broader threat that's happening in the EV space. And as Ray kind of touched on it before the break, where she was talking about lithium prices coming down, it is about softening EV demand.
Yep.
For Lucid, it's become even tougher, right? If we sort of pivot to the other EV name we're watching today, because consumers are turning more cautious. We're talking about a car that is well above $70,000. Lucid reporting just 1,457 deliveries for the third quarter. They've gone ahead with promotions. They've tried to be really aggressive in some of these price cuts. It's going to be an interesting call tomorrow when they report those results because things are not necessarily looking great in this space.
No, right.
Tesla is more sort of a mass vehicle. Lucid is very, very select when you think about the higher price point that they offer. It's not just about softening demand, but consumers are going to be taking on a loan with the higher rates as well.
Yeah, you bring up the sentiment has shifted, right? Because as you point out, so you had this demand issue, higher rates, so you slash prices, but of course that has pressured profit margins, and you've really seen investors react when you look at the stocks of some of these names going forward here.
Let's talk about another brand that Josh and I like to wear, right?
Oh, yeah.
Birkenstocks. Analysts are initiating their coverage on Birkenstock less than a month after its IPO. Wall Street brokerages largely giving the shoe manufacturer their top ratings. Morgan Stanley saying the positives are largely priced in, specifically looking at JP Morgan here, overweight rating, equivalent of a buy with a target of $48. BMO Simeon Siegel coming out with an outperform stock. He's saying, or outperform rating, I should say, $50 price target. UBS's Jay Sol, which, by the way, has the best name for any analyst who covers shoes. One of few analysts who are a little more cautious with a hold call, saying this is largely about valuation, that yes, there is growth potential here for the company, but that's already been priced into the stock.
Yeah, I'm a big Birkenstock guy, as you know. I have 2 pair, but just so America understands, Akiko actually has 4 pair, which puts me to shame, obviously. I mean, I thought I was a Birkenstock guy, but I think I'm close.
4 pairs, right? There's a lot of collaborations that come out, a lot of opportunity. Some of these are very limited, right? The exclusive Birkenstocks are the ones.
Let me ask you, when you
move
move up the exclusivity ladder, does it stay comfortable though? Are they so?
It's the same Birkenstock.
So same deal.
That's what's great. You've got a premium
so you get
brand,
the fashion
right?
and the comfort. All in one.
There you go. And then you have an excuse to wear those Birkenstocks, right? You can say, like, it's a brand collaboration.
Yeah, now last question, do you wear yours with socks? That's always the question.
No, I'm
really?
not there yet.
No, I'm there.
I think
I'm married, so it's fine. It doesn't matter. Yeah.
In the winter, I don't know.
All right, let's move on to Disney. Let's check out those shares today. Trading, where did we finish? Did we finish higher? Let's see. No, we finished down about, let's call it 1%. The news that it has finally appointed a new chief financial officer, longtime PepsiCo CFO Hugh Johnston will become CFO of the media giant effective December 4th. That announcement comes just days before the House of Mouse reports earnings. Here to help us go through what to expect there is Jason Bazinet, City Managing Director. So Jason, thank you so much for joining us today. First of all, let's just get your take, Jason, on this news, this C-suite change here, the CFO, Hugh Johnston. Are you a fan of that decision, Jason? And what do you think Hugh's priorities should be here?
Well, look, my inbox lit up with people that were very excited about this hire, so I think it was a good hire for Disney. But I would say in the grand scheme of things, Disney, has much bigger issues that it has to contend with, above and beyond sort of C-suite changes.
What would you put at the top of that list, Jason? I mean, Josh and I were just talking about some of the cost disciplines, cost issues that Disney will have to address, whether it's in their streaming side of things or their, what some would say more their legacy assets and what they actually do with it. Where do you sort of rank the priorities for the company?
Well, the first big overhang for the stock is they have to buy the balance of Hulu that they don't own. The street doesn't know how much they're going to pay for it, and it goes to a third-party appraisal process. So that's a big unknown that we won't get an answer for until early in 24. They're also talking about selling ABC, selling the India assets. Those are 2 big, reasonably sized assets. We don't know what the proceeds are. And then there's ESPN, where the company's talked publicly about potentially giving an equity stake to some third party, presumably leagues. And then there's the overall aspirations on streaming. I mean, right now the market is operating under the assumption that it's sort of a winner-take-all market in streaming, where Netflix wins and everyone else in the legacy media side, including Disney, is a loser. And so Disney somehow, in that giant mix of variables, has to figure out how to sort of right the ship and get their streaming business valued properly by the street.
And Jason, there's a lot to unpack there. You mentioned ABC, though, and Iger has talked about divesting traditional channels like ABC. What are the value of those assets, Jason, and who do you think potential buyers are?
Yeah, so on the ABC side, they don't disclose the financials, so it's our best guess. But I would say it probably has an enterprise value, and I'm including both the network and the TV stations, probably around $6 billion. The India assets are probably worth around $10 billion. The Hulu stake, that's a big unknown. That's going to be an outflow, but it could be 10 billion, 20 billion. We just don't know. It depends on that third-party appraisal process. So a lot of big dollar amounts moving around.
Who do you think makes sense, though, and who would be interested in buying that?
Yeah, so I think Reliance has been talked about in the press on the India assets. On the ABC assets, I think the easiest fit would be a TV station group like Nexstar. They don't own, Disney only has 8 TV stations, mostly in very large markets. Fresno's the smallest market, but it's big markets, New York, LA, Chicago. And there's very little overlap with Nexstar. So that makes sense. It's sort of easy for them to plug into their existing portfolio with very little friction.
And Jason, I also want to ask you about the parks business. One, interested to get your take on what you expect to hear about that on Wednesday. And secondly, just their strategy here, Jason. I mean, they're obviously very much leaning into the parks. They're investing $60 billion. Do you think that's the right strategy?
Well, it's so interesting. I've covered Disney long enough where the buy side used to complain about the parks business being very capital intensive. And now you talk to investors and they think of the parks business as the best business that Disney has. So does investing more capital make sense? I mean, it does if you look backwards and you say, what are the returns on invested capital that Disney's generated in the parks? It's generally in the low double-digit range. So that's above their cost of capital. That's a good use to deploy more dollars. The outstanding question we don't know is, can they maintain that level of returns on the invested capital, if you double the amount of capital that you're going to invest in the business? That's a TBD, but I'm assuming that Disney is going to go slowly, right? This is a long-term, decade-long plan, nothing that's going to be immediate.
Jason, specifically on Disney Plus, so many issues to sort of wade through. We have seen the question about cost, trying to bring additional subscribers in, the ad-supported tier. What are the key levers that you think that you're hoping to hear from the company in this earnings call this week?
Well, let me just start with a very big picture sort of observation. I would say Disney has had a pretty muddled message in terms of what its ambitions are on the streaming side. And by that, I mean, we don't know if Disney plans to be what I'll call a pay TV substitute, which is what I would call Netflix, or if its aspirations are more niche oriented, which is really what I think of as Disney Plus, right? That's not a mass market offering. It's good for Disney fans, but it's not a pay TV substitute. They just don't have enough depth of content. So what I'm begging the company to do is be crystal clear about what its ambitions are. And I strongly believe that they should go try and become a pay TV substitute. In other words, have the depth and breadth of offering that it actually could serve as something that consumers would view as one of their primary hubs for entertainment. The messaging has been mixed because Mr. Iger went down the path of acquiring Fox, getting a controlling stake in Hulu. And then he came back after his 2-year hiatus and said, well, I'm sort of concerned about undifferentiated content, which the street took as code for Hulu. So we don't really know if he wants Hulu or what his ambitions are in the streaming side. That's the first point, and we'd love clarity there. The second point that I'd make, and this is not appreciated at all by institutional investors, is that you've got Netflix out there making $6 billion of EBIT. You have all the collective incumbent media companies that in 2022 lost $10 billion of EBIT. And that's a very counterintuitive financial outcome because you'd think the incumbents have an advantage. And here's the part that the buy side doesn't understand. There is nothing structural about why traditional media companies can't make money in this business. 80% of the EBIT spread between Netflix and the traditional media companies is because their ARPUs are too low. 20% of it is because they're spending more on advertising, marketing their apps. If they could get those two right, they could generate as much in streaming as Netflix does.
We'll be listening to some commentary if that comes through. Certainly interesting takeaways there. Jason Bazinet, City Managing Director. Appreciate you joining us today. Thanks so much.
Yeah, absolutely.
Well, time now for what to watch on Tuesday. Be sure to tune into Yahoo Finance's Invest Conference. We've got some big names ready to discuss the most pressing issues in the investment landscape today. Our coverage starts at 8:30 a.m. Eastern Time. Meanwhile, on the earnings front, Uber, D.R. Horton, and Planet Fitness all reporting their quarterly results before the opening bell. Then after the market close, expect to hear results from companies including Rivian, Robinhood, Occidental Petroleum, and Kava. As for the economy, we're going to get the latest reading on the U.S. trade deficit for the month of September. Meanwhile, the Fed will release its latest data for consumer credit. Lastly, don't forget to cast your vote for Election Day, this coming ahead of next year's presidential election. Voters will head to the polls to weigh state and local proposals on issues ranging from abortion, taxes, and housing.
That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 8:30 a.m. Eastern for Yahoo Finance's Invest Conference. We've got a whole day's worth of engaging conversations with power brokers in the world of business, finance, and politics. Don't miss it.